Hey everybody, Marty Missouri here. It's the 29th of October, 2023. This is your weekly economic update. I've got quite a bit of stuff dialed up for you today, so I am going to run through it fairly rapidly. Initially, we're going to focus on the consumer. We're going to look at some improvement in the Chicago Fed National Activity Index. I want to look at the Economic Surprise Index. I want to speak to the market action a bit of late and what we anticipate in the short run going forward. That would be the equity market. We'll look at the latest in terms of market signals about the economy. And then I do want to spend the last minute or so just taking a look at just the chart of the S&P 500 because I think it looks interesting coming into a week with important stuff coming our way. Things like central bank policy meetings and U.S. job numbers at the end of the week. And of course, more earnings announcements that not only can move the market for a particular stock or a particular sector, but also, as we're going to get into a little bit today as well, the detail in those earnings calls can give us some insight about the economy. So, jumping right in. We had no change week over week in the PWA index, negative 19.15, still in that odds favor recession going forward range. I'm going to just click through 4 screens here on the consumer, and then I'll just sum it up by paraphrasing from Peter Bookvar's commentary about this consumer data that just came out. So definitely a nice pop in consumer spending. Personal income, essentially, as you can see, came down a little bit. In terms of inflation, as you can see here, the white is the headline. It essentially stayed flat at 3.4. Core, which X's out food and energy, came down just a little bit. All of it still way above the Fed's target. And as you can see on a month-on-month basis, call it 0.4 rounded up for the headline. Core was 0.3. Notice the consumer savings ratio continues to roll over. 28-year low for mortgage purchase applications. Of course, we have 8% mortgage rates right now, so that should come as probably no surprise to anybody. The Chicago Fed National Activity Index, it actually went back barely into positive territory. This is an index within our index. It's got 85 data points that they track. 47 in September came in positive, 38 negative. The U.S. Economic Surprise Index popped up to 64. This essentially says that the economy or the data of late has come in better than what economists had previously forecast. Sectors to the S&P 500 ratio. Here, just to look at the short term. So this is a 1-month look at each of the major sectors and scoring whether or not they are outperforming or underperforming the S&P 500. So tech toward the end of last week got a pretty big bounce as the S&P continued to roll over. So tech of late has been outperforming the broader average. Financials underperforming. Discretionary stocks notably underperforming. Materials performing right there with the S&P. Energy underperforming, and industrial slightly underperforming. The point I want to make here is that the economically defensive sectors, the ones that tend to do better during recessions, staples notably outperforming, utilities hugely outperforming, although utilities are still down like 15% on the year, and then healthcare about in line, slightly outperforming as well. So if this were to continue, looks like a rotation from things like consumer discretionary stocks, right, down to things like consumer staple stocks. So that can be interpreted as a potential warning from the equity market at an environment where consumer staples, and we'll talk about this a little bit in these earnings reports, is where people are spending their money going forward as opposed to consumer discretionary, and of course that would be a weaker economic environment. Same thing of late with the stock to bond ratio. So S&P 500 versus TLT, the 20-plus year Treasury bond ETF. So when this is rolling over, stocks are underperforming bonds. And of course, as you know, they've been outperforming all year. Bonds have been an unmitigated disaster for the last couple of years. Well, lately here, they've been showing some signs of life, certainly relative to the stock market. And of course, when bonds do better than stocks, particularly treasury bonds, high quality bonds, that denotes perhaps a rotation over to safeties. This is short term, this is recent, and there's lots of dynamics in play when it comes to interest rates and treasury issuance and so forth, but clearly it's something to pay attention to. An interesting, harbinger of how the economy is doing, at least that's the perception, is the price of copper. And so copper has been, trending lower here, definitely since March of this year. And though I'm pointing to here this morning a clear descending wedge pattern, a buy signal on the moving average convergence divergence, and now we have quite a bullish divergence there, and coming off of oversold territory and a bullish divergence in the RSI. So just from a pure technical perspective, it looks like copper is kind of staging for a rebound here. Copper is very sensitive to headlines out of China. Clearly, if you've been following China as we have, they have been incrementally and then stepping up the size of the increments, if you will, doing things to stimulate their economy, stimulate their markets, and so forth. And to the extent that that means infrastructure spending, copper, again, is very sensitive to global dynamics, but uniquely sensitive to the Chinese situation. Okay, so I'm going to leave it on that screen for a second, and I'm just going to paraphrase from Peter Bookvar's excellent summary of what's been going on, and this is on the consumer end. Then I'll just rush through notes on some earnings calls, and then I want to talk about the graph you have in front of you, and then take a quick technical look at the S&P 500. So from Mr. Bookvar's notes, yes, Q3 consumer spending was a blowout, but the quarter ended with a savings rate of just 3.4%. versus 4% in August, 4.1% in July, 4.9% in June, and 5.3% in May. I'm sensing a trend. That matches the lowest since November of 22. By the way, that compares with a savings rate of 7.7% in February 2020. Remember, people ramp up their savings during recessions. And thus, the current pace of spending in Q3 is just not sustainable at that pace. I couldn't agree more. Higher income consumers are mostly spending on travel, restaurants, and other hospitality things. Most others are prioritizing their spend on essentials. Everyone is spending on live entertainment like concerts from Taylor Swift and others. And you're going to sense some of this higher end spending versus lower end not spending when I peruse through some of the earnings statements here. This lower savings rate comes after a 0.3% rise in income and 0.7% increase in nominal spending. Spending on services were higher by 0.8% month on month and by 0.7% for goods, driven by a 1% rise in durable goods, most likely led by vehicles. Private sector wages and salaries were up 0.3% month on month, while government wages jumped 0.7%. On inflation, headline increase was up 0.4%, 1/10 above the estimate, while the core of 0.3% was anticipated. Year-over-year gains were 3.4% and 3.7% respectively. Service price inflation was up by 0.5% month on month, and there was a 0.2% increase for goods, solely driven by non-durable goods. Personal income was up 0.3% month on month, 1/10 less than expected versus a 0.4% increase in August. Private sector wages grew by 0.3%. Government saw a 0.7% rise. Okay, and just going to run through a dozen or so notes we have on earnings calls. As for Amazon, shoppers showed strong demand on essentials, cautious about price, trading down and seeking out deals, lower spending on discretionary items, business ad spend growing nicely, but they're getting cautious. Capital One, 30-plus day delinquency rate, now modestly above 2019 levels. Auto loan originations down 10%. Auto loan charge-offs modestly above 2019 levels. So, again, this is the kind of stuff I talked about of late. That doesn't sound too scary, but it denotes a move in a concerning direction, I would say. Whirlpool, market environment challenging globally. In the U.S., however, demand has been solid, but that's entirely driven by very strong replacement demand related to increased appliance usage at home, a trend we expected and expect to continue. Discretionary new purchases have been softer than expected. Blame high mortgage rates and low consumer confidence. International paper, industrial packaging stable overall, beverage and processed food stable, and they expect even more improvement there in Q4. Hershey's, value and affordability top of mind for consumers as budgets are stretched. Less government assistance, student loan payments starting back up, higher interest rates, etc. Customers are reporting that they have to make difficult choices. Chipotle, Q3 was good, trends remain strong, continue to see transaction strength, so nothing scaring Chipotle right here. Hilton Hotels, demand improved in the third quarter, strong international performance across all segments and regions, with system-wide occupancy for Q3 the highest post-pandemic. So folks are getting out there still, no doubt about it. Royal Caribbean Cruises, bookings remain strong in Q3, consumer spending on board and pre-cruise purchases continue to significantly exceed 2019 levels, driven by greater participation and higher prices. Now, I capitalized in my notes higher prices because, folks, as long as people are out there spending, even if they're spending from a volume perspective the same amount, higher prices are going to make it look like things are booming. And essentially they are for the companies if they can continue to see the same volume while they're ramping up their prices because of inflation. Again, ultimately, this is unsustainable, but people clearly are still going to concerts, booking hotel rooms, and booking cruises. Visa, for example, data did not indicate any consumer behavior changes. Now, not all credit card issuers are telling us that, but that's what Visa said. General Motors, we hear reports that consumer sentiment is weakening, but we haven't seen that in any lack of demand. Meta or Facebook did see softer ad spend to start Q4, and their stock certainly reacted to that. Landstar, a North American truckload carrier, lackluster demand driven by continued weakness in U.S. manufacturing and an ongoing impact on an inflation-challenged consumer goods sector. And then we'll stop with Taylor Morrison, the home builder. Rapid reacceleration in interest rates in September has once again injected some hesitation into the market and drove a moderation in sales momentum that has continued into October alongside typical seasonal slowing. So as we look through the data, strength of the consumer, yeah, we are seeing things like some lower performance, and I've mentioned this from other sources here the last few weeks, in the credit space, cutting into their savings and so forth. Clearly, we see those signs of weakness, and I'm going to talk about the chart that you have in front of you here. But for the most part, nothing dire yet, nothing that says that recession is going to start tomorrow. Now, these things can come quite rapidly, and I think the setup is for that this time around. But the market, as I've said over and over again here of late, actually isn't looking for, the bulls aren't looking for good, solid data that is going to keep the Fed emboldened with their high interest rates at these levels. I don't think they're going to raise again. I don't think they should, quite frankly. But the market wants them to ultimately really ease off the pedal, and we're not getting anything that says that they should just yet. And I think it's going to come quick, and I think they're actually going to even ease off the pedal, perhaps more than the market has anticipated. And I think that is the makings of the last leg down in the bear market. What we've seen of late, I'm very skeptical that this is the beginning of the last leg down, because I think it's selling, yes, based on some disappointing earnings, but maybe more than that based on decent economic data that comes in. Now, as I've said lately, when the data really starts rolling over and people start seeing it everywhere, well, then I think the market could very well rally, because it's going to view that as the Fed is going to come to the rescue. But again, corporate earnings, and that's what this chart here is all about, just do not reflect a recession, right? So this one here in front of you, I keep showing this over and over again. It's our ratio of leading to coincident indicators. And when it's rolling over, the leading indicators are underperforming, so to speak, the coincident indicators quite dramatically. You can see we ticked back down here this last month. And we've never been in this area, right, without either being in recession or entering recession. Okay, so this could be a first. And this is S&P 500 earnings, right? So, there's a little bit of a concern right here, but this, and of course the stock market will go with it, and it really doesn't matter when this rolls over if the Fed is cutting interest rates to help out. Once we're in recession, that typically has to play out. And the first few rate cuts probably don't catch the falling knife, or they don't typically. Now, folks, we are sitting on quite a bit of liquidity. We're hedged with options that if this is swift, will create quite a bit more liquidity and so on. And we have defensive things in there like longer-term treasuries that I think will do very well in this scenario, right? So we will have more than adequate liquidity to take advantage of what inevitably comes, and that is things like equities bottoming, while everyone else is panicking roughly halfway through the recession. But as I've said over and over and over again for this last year is we've got to remain patient and let these dynamics play out and the next leg down to come, or let these dynamics basically fade away and tell us that it's safe to add risk or add equities or add different asset classes that we want to own going forward to the portfolio. Neither of these things has occurred just yet, so we have to remain patient. And the other thing about this look here, and I want to read from another research partner of ours, Numera Analytics. This is I'm going to read it from a report that they did, and the start of this paragraph is titled "Late in the Game." Consider the following scenario: an economy that's been growing above trend for the past year, facing above target inflation and peaking policy rates after an aggressive hiking cycle. Imagine, in addition, that while the economy continues to overheat, leading indicators, and that's this, have been warning of a slowdown for some time. That's exactly what I've been talking about. If this sounds familiar, it's because it illustrates the state of the economy, and you've been hearing that here over and over again. But for investors who experienced the 2001 and 2008 recessions, and believe me folks, I did both intimately, this description may stir darker memories. Why so? Because today's climate bears a close resemblance to the period immediately preceding both crises and every other late cycle of the past 40 years. So, folks, as I'm sure you know, certainly clients know this. We don't just make this stuff up. We don't wake up feeling this way. Our view of the world right now, view of financial markets, of asset markets, comes from 30 plus years of experience working through them, and just a tremendous amount of work and analysis and deep dives of our own, and our biggest budget, of course, other than labor, is research that other people who we respect do. Nobody who's got any innate biases, not Wall Street research, but just true, deep, thoughtful macro research from some of the world's best macro researchers. So when we come at you and say, this is a time to be cautious, it doesn't mean that we know what markets are going to do tomorrow or even next year. All it means is that we know that we are treading on some relatively thin ice right here that we need to be careful with. We need to hedge. We're hedging pretty aggressively right now, and we need to stay on our toes and, frankly, be ready to take full advantage of what's to come. And that's going to be as key as being defensive during uncertain periods like we have right here. And then lastly, with regard to asset markets, I know everybody's interested in the stock market, and I'm just going to do this really quickly. There'll be, Tuesday night or Wednesday morning will be the next more detailed analysis just about markets. But remember, those of you who watch the videos, I drew this very compelling looking bear flag, and this one is played out virtually right to where it's supposed to. So here, Actually, I started a little too low, so it actually is right on this yellow line that I've had drawn here for quite some time. It's exactly where the market bottomed on Friday and bounced off of that. Folks, we break through this with momentum this week, and this could get below in a hurry. But the technicals suggest that we're going to get a pause here. And let me show you the MACD and the RSI. So remember I said if we bounce right here, we're going to get a nice bullish divergence, and that looks like that could very well happen. Okay, so here is the MACD. Not just yet. This would come the first of this coming week. But continue this bounce off of here. We're going to break back up here and probably start with some resistance at 4,200. The RSI just dipped into oversold territory below 30 on Friday. You can see I circled this here. We didn't really have bullish divergence here, but we did have an oversold RSI, and we had a MACD that quickly rolled up into a buy signal. And there was the end of this first leg down here and the beginning of the forming of the flag pattern. So we retraced roughly half of that, which is what we typically do with a bear flag, and then rolled back over. Now we are below the 200-day moving average. That could be resistance. But if we do pop this week, I do think there's a good chance that we retrace a bit of this decline right here before ultimately we expect to roll back over and plumb some new lows for this market. But that may very well be, at the first half of next year affair. Take a quick look at the hourly chart. This is just really pointing to a pop the first of this week. See the falling wedge, see the bullish divergences, right? Notice the falling wedge back here, and then notice the bullish divergences, okay? Coming off of oversold territory. So that's the look we have right here. And we got a little bit of a bounce here, consolidated that, and then rolled back over. That's the kind of thing I think we should expect. Now, notwithstanding that though, a hot jobs number is going to be hell on the market. A firmly hawkish Federal Reserve, going to be hell on the market. So these technical indicators that say we could get a bounce this week could fail famously if the data continue to come in hot, if central banks continue to sound hawkish, because again, that's not what this market thinks it wants right here. And so that we get this particular leg of the bear market could get more exaggerated to the downside. But I'll say it one more time, the reason I'm such a skeptic that this is it is because it's not characterized by the kind of fear and falling stock prices that coincide with falling earnings, that coincide with a recession. This is virtually the opposite of that. This is fear that things are too good, that they're going to heat up a little more, and that the Fed is going to continue to keep with higher interest rates because it has to, because of the inflation setup. So folks, I know I'm beating that dead horse, but lots to come. Thank you, as always, for watching and listening. Be back tomorrow morning with a written note, and yes, again, next week's going to be very interesting. Take care. Have a great rest of your weekend. Bye-bye.